What is going on, YouTube Nation? This is Darth Dividend. If you guys are new to my YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. I got two dividend stocks for you guys to buy. These guys are actually rivals, and they don't like each other. There's a big rivalry. It's just like Ohio State and Michigan, red versus blue. I got a bonus stock that's included with these. It's actually, they can claim they're rival, but they're not really a rival to these other two companies. So these are companies that have increased their dividends. These are the two ones I'm discussing. And this bonus stock is starting to make a little bit of a comeback. So I want to discuss that with you guys as well. So if you are new to this channel, make sure you subscribe and hit the notification bell so you don't miss future videos. Let's check these stocks out right now. And we got the first stock, Coca-Cola. Take a guess which the next one might be. So this is sitting at $53.73 with a 3.13% dividend yield, a PE ratio 26.44, a market cap of 232.08 billion US dollars. A year range is 48.11 to 57.56. So I'm going to explain why this one could be better than its rival after I do this video on these two stocks. So I'm going to explain them. I'm going to show you their dividend history. And this one is a Warren Buffett stock, and this one hasn't done too well against the S&P, but that's not too bad because Coca-Cola consistently increases its dividend. Coca-Cola is a very popular company. It owns a lot of other beverage companies. Fairlife Milk is another one. That's a big one that's very popular as of late. I've tried it before. Body Armor is another one. That's a big thing that Kobe Bryant was a part of when he acquired Body Armor. Coca-Cola completely sucked those guys up. So that's something that's very interesting. And there's some more interesting things with Coca-Cola. I'm going to show you their revenue, how they're doing, and why Warren Buffett owns them because they have a rich tradition in increasing their dividends. So here's the thing with Coca-Cola 2014, 2015, 2016. They were in, this is in millions of US dollars. They're sitting at 41, 44, 45, then 36, 34, 37, 33. So they did decrease their revenue a little bit. You can claim the pandemic card in 2020, but they started to increase their revenue. And again, these acquisitions, they're starting to make big moves, and they're starting to get bigger and bigger. So as a company, they still have a lot of promise. There's still high expectations with these guys as a company. The more people they acquire, the more powerful they're going to get. So that's the one thing about Coca-Cola, which is very nice. I'm going to jump to their dividend history. We'll start in 2013. 28 cents, 30 cents, 33, 35, 37, 39, 42 cents. They have a 3.03% dividend yield, PE ratio 26.34. I'm going to tell you, I love Diet Coke as a product. And their Coke products people buy like crazy. Diet Coke's very popular. I mean, they have so many things that are good out there, and they're in demand. You see people in the store just buying Coke products like crazy. So that's one thing to look into with Coca-Cola. Again, it's $53.73. That's not too bad. Somebody like me in grad school that's trying to be cheap, be frugal, that's pretty affordable stock. Let's jump to its rival. That next stock is Pepsi. It's sitting at $161.14, a dividend yield of 2.67%, PE ratio 27.49, market cap 222.80 billion US dollars. Year range is 128.32 to 166.80. So already it's a lot more expensive than Coca-Cola. Now Pepsi is a juggernaut of a dividend stock. I mean, Coke's good, but these guys are very, very powerful. They're the blue. So Coca-Cola's the red. These guys are the blue. So they're like the Michigan, and Coca-Cola is like Ohio State. But, well, you can always say that, Pepsi is beating Coke, though. And, Michigan used to beat on Ohio State. So that's one thing to consider. But for me, $161.14, that's a lot of money. I don't have that type of money. And if you had $10,000, throw it in Pepsi. Okay, Pepsi or Coke, your Coke is a lot cheaper than Pepsi's. That's one thing to consider. And the dividend yield is a little bit better with Coke, but Pepsi is like huge. I mean, they own like Frito-Lay, Quaker. I mean, they're just huge as a company. I mean, it's not just beverages that these guys have, they own other stuff. I mean, Frito-Lay, Gatorade. I mean, it's insane how big they are. And I'm going to jump to its revenue. And this is in millions of US dollars. So you have 66, 63, 62, 63, 64, 67, 70. They're going up. There is a lot of promise, and these guys are going up in price per share. So that's a lot of promise. That is very attractive. And hey, increase in revenue. That's what you want to see as an investor. These guys are in demand. People like these guys as a company. Let's jump to its dividend history. And here's the thing with Pepsi. Look at this: 2014, 15, 16, 23, 26, 30, 37, 42, 45, 48, 51, 53, 56, $1.07. So you're seeing dividend hikes like you wouldn't believe it. It's jumping up like crazy, but again, it's a little bit more expensive compared to CocaCola. Now, one strategy I have with my M1 Finance dividend portfolio is I'm going to have a super section in my dividend portfolio. I'm going to probably have Pepsi in it. I'm looking at having Pepsi in it. So all my dividends can start buying. I mean, once I start racking up $500, $600 a month, I want to be buying Pepsi. Products like Pepsi, 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 Pepsi. Because you're seeing, look at these dividend increases. That's what I'm looking for. I want to buy, some of the more conservative stocks. I would consider this a more conservative stock, but it has consistent dividend increases. But the problem with these guys is they're so expensive. Coca-Cola is a lot cheaper, and it has a little bit of a dividend yield that's higher. They both increase their dividends, but I don't have that type of money to have 50, 60, 70 shares of Pepsi. I can do that with Coca-Cola. So that's one thing that's a disadvantage of Pepsi. They're so big that people, 160 is a lot. I mean, now again, Pepsi's a really good Roth IRA stock because it's increasing its price per share, it's increasing its dividend. That's one thing that I can see, a lot of people liking about Pepsi is throwing that in their Roth IRA. So that's attractive as a day trading stock, traditional or Roth IRA. But if you have the money, I mean, that's expensive. That's really expensive at $161.14. I can't rack that up. I got enough for Coca-Cola, but Pepsi's an awful lot. Now I'm going to jump to the bonus stock. This one thinks it's new kid on the block in the beverage company. It's getting there, but it's not as attractive as you think. But maybe eventually it'll get back to where it was. And that stock is KDP symbol Keurig Dr. Pepper, sitting at $34.98, dividend yield at 2.14%, PE ratio 28.83, market cap 49.60 billion US dollars. Its range is 29.89 to 37.11. Okay, so what is so good about these guys that I put them as a bonus stock? One thing I like about these guys, the revenue. This is in millions of US dollars, 6,000. Now we're at 7,000. Now we're at 11,000. So it is increasing its revenue. These guys are doing something right as a company. Now I'm going to show you their dividend history. We're starting to get somewhere. 15 cents. A little bit at 15. Now it's at 18. So keep an eye on Keurig Dr. Pepper. KDP is the symbol. It's at $34.98. Deeper than Coca-Cola and Pepsi. 2.11% dividend yield, not bad. It is slowly increasing its dividend. So keep an eye on these guys. KDP is a stock. KO for Coca-Cola, PEP for Pepsi. Let me know what you think. Do you like Coca-Cola or Pepsi better? Let me know about KDP, who thinks that they're the new kid on the block. So keep me posted on those 3 dividend stocks and share your thoughts. And if you're new to this channel, make sure you subscribe and hit the notification bell so you don't miss future videos. This is Darth Dividend. You guys have a good one. And go Bucks.